everybody. Thank you for joining us. Sorry we had a little technical difficulty getting started this morning, but hopefully we're all straight now. Really appreciate you having us with us. Really appreciate you being with us today. Excuse me. Last time we were here, we had Robbie Davis, and we had hoped to have Bob Pike, but we had a scheduling conflict there, and so he's going to join us next week. And graciously, we have Dave Ashman back with us again today. Trevor and I thought this was mighty timely to have Dave talk with us about rates. After all, we talked about tax rates last time we were here, and now we're going to talk about interest rates. So Dave, thanks so much for being here.
Absolutely. Thanks for having me back again. And just want to say welcome to the spring housing market. We're in full swing right now, so there's a lot of positive things going on in the market right now. Pipelines are filling up, people are busy, so there's a lot of good news out there. I know everyone's right now is concerned about interest rates, and
always, right?
Yeah,
always.
Always. And they kind of are where they are. We're at the 7+ range right now, depending on various factors. But hey, over the course of time, that's still not a bad rate historically.
Right. Do you have a lot in the pipeline too right now? Like, I read in the news, like on a national perspective, that there's a lot of people applying for mortgages right now.
It's very busy. Yeah. It's very busy. And in fact, comparing it to last May, I'm more busy than I was a year ago.
Wow.
Okay.
And that brings me to some quick housing stats. Nash County closed at this time from January to April last year, closed 222.
Okay.
Then this year, January to April, 231.
I love that. I love that. Up.
So,
good.
And I did do Edgecombe, and last year 103.
Okay.
And it's
okay.
a little down this
Okay.
year, but
Okay.
only 83.
Okay.
But
Okay.
those are pretty good. Still strong,
Yeah.
moving along market.
While you're doing numbers, will you share what's active on the market in the two counties? Because
yes, active are 192 in Nash County, and there are 112 pending. So properties that are under contract haven't closed yet. 112. Edgecombe active are 76, and pending 55.
wow, that's a lot of pending. That's great.
And Sterling and I, we were talking about how not a lot of existing homes, well, there are, but more new construction right
So
now.
much. I'm sure you're seeing that too, Dave.
I am. People are, it's the old adage back in the COVID days or whatever, the interest rates. A lot of people had those 2% and 3% interest rates, and there's stubborn and reluctant, understandably so,
Sure.
to give those up right now. But
And so it's really a lot of the new buyers or relocation buyers, and there are many new properties in our area, and so
Sure.
I guess that is truly what they're seeking. Good price
Right, and there's
point.
not really any difference loan-wise for an existing house to new
Sure.
construction, right, Dave?
there isn't. No,
Right.
it's exactly the same.
Yeah.
It surely is.
So, Dave, one of the things we talked about wanting to have you on is to go over some kind of definitions that people hear, or terms that people hear when they think about interest rates. But before that, we've kind of anecdotally talked in the office about how this is an election year, as if you didn't know. I know you know, right? This is an election year, and you have said historically rates tend to decrease during election years. Talk to us about that.
Yeah, historically they do tend to go down in an election year. The economy usually reflects a better position than maybe it might typically be in, which can influence rates. And we know back in, I think it was in January I was here, we were talking about the Feds maybe having more cuts this year. And of course that can has been kicked down the road. Inflation's been very stubborn. And hasn't come down like we thought it would be. And in fact, last month it went up.
Boo.
Boo. So it kind of shocked the market there. I still think there might be a rate cut this year. When that happens, it's going to influence interest rates. They're going to feather down. And while we're busy right now and people are buying and selling houses, there are people on the sidelines that are waiting for those rates to come down a little bit. When that happens, we're going to see a frenzy, in my opinion. We're going to see a frenzy. Everybody's gonna be
People want to jump in and get in.
Yeah, people on the sidelines are going to jump right in the game, and we're going to see a great thing. So that's another reason why I always say, the old the old saying is, date the rate, marry the house, has never been more true than it is right now. Because when that happens, it's old supply and demand. When there are more people in the market than supply or houses, then prices are going to go up. So you're not really saving any money by waiting. You're going to pay
point.
more for the house later.
Yes.
Even when the interest rate comes down, I think you're probably going to be in a worse situation. Plus, you're going to have to be dealing with multi-offer situations where it's going to drive the price up. You might not get closing costs back. You might not get certain things that you want that you could get right now.
Super
Good
helpful.
point, yes.
All right, so can we talk about what a credit score impacts your rate?
Sure.
Because this is a question I know Trevor gets, I get, and I know you probably
Oh yeah,
get this.
it's the old mystery. Everybody wants
Yes.
how credit card. So first of all, we pull a credit score from the 3 credit bureaus: Experian, Equifax, and TransUnion. They score a customer on a mortgage model. So these people that are out there that go to a Credit Karma or Credit Wise or something like that, that's not a true score. So we get 3 numeric scores from the credit bureaus, right? And we knock out the highest and lowest and use the middle score. And that's the indicator score. Now that score is very important because, especially right now in the market and pricing out interest rates, that score drives what kind of rate you're going to get. So the higher your score, the better rate you're going to receive.
And how does it usually impact it? By an entire point, or is it not the same every time?
They're variable factors. It could be
Okay.
loan type, loan size,
Got it.
the
Okay.
strength of the borrower. It could be a quarter. It could be 1/8%. It could
Okay.
be,
So it's pretty low.
yeah, And
But everything matters
Right.
on that rate. That's
everything
true.
matters.
Yes.
And the further that there is a distance between, if you had a 580 credit score, if you had a 780 credit score, then it's going to be a bigger spread.
Okay, that makes sense. All right, something else Trevor and I hear about a lot is we often, many buyers want a fixed rate mortgage,
Right.
15 or 30 years. So talk to us about the advantage of that, and then we'll look at what kind of is an ARM.
Okay, sure. Well, 15 and 30, obviously, 30 years, 30-year fixed rate, and 15 is a 15-year conventional fixed rate. I always tell my customers to consider the 30-year because there's not a big difference in the rate right now. In other words,
Okay.
at one point the 15-year was much lower than the 30-year, and it made sense.
Okay.
Right now that is compressed, and it's not a big difference in rate. What happens when you do a 30-year mortgage is obviously your payments spread out over 30 years, so your monthly payment is less, right? You can pay more, you can control how much you pay.
You
but
can
you're not-
always overpay.
Overpay,
Okay,
yeah.
there's
the
no
principal.
penalty for
There's
that.
no penalty
Okay,
for
okay.
that, so you can pay it off, the next day if you like, at least with us. But if you do the 15-year, you're kind of nailed into or restricted into a higher payment. Your minimum payment is
Okay.
very high,
Okay.
right?
But the interest rate does go down.
Interest
a
rate
little.
does go down, and that's the environment we're in right now. That could be different 3 months from now.
Well, I
But
know
it
we
used
have
to
a-
be it would be a large spread between those
Yeah.
two.
It used to be where it made a lot
Okay.
of sense if you could afford that payment to go with a 15-year.
Okay, okay.
Yeah,
You
I
may
know
pay
we
it.
have a client right now, we're trying to lock them in, and I was looking how you kind of,
Yeah, between the 30 and the
Yeah.
15-year.
Okay.
So it's all about flexibility and, on your payment on that, between a 15 and a 30-year.
So that brings us to an ARM or an
Okay.
adjustable rate. Talk to us about the advantage or disadvantage for buyers who are looking at a mortgage product like that.
I would say this, and a little personal opinion right now, I'd be careful with ARMs. An ARM is an adjustable rate mortgage. That means you're going to close at one rate, and it may or may not go up. I'm going to tell you it's going to go up. The likelihood of going up is 99.9%. So you might start off at a 6% rate.
Okay.
In 2 years, 3 years, however that adjustable rate mortgage is set with the parameters, you might end up with an 8% rate as it escalates.
And that's where people say it's a 5-year ARM or 7-year ARM is you're locked into that rate for a certain amount of time. And then,
exactly.
Okay.
You're
okay.
locked in for a certain amount of time, and then it can adjust and will adjust. It works for certain circumstances. If you're getting transferred with a job and you know you're only going to be in that market for 3 years or 5 years, maybe it's worth it. I would say just make sure you weigh out your options and what's very best in your situation.
Okay, okay. All right, talk to us about, Trevor and I were discussing this before we came in, PMI.
PMI, yeah, it's private mortgage insurance. So when you do a Freddie Mac or Fannie Mae or conventional loan, which is just a 30-year fixed rate mortgage or a 15-year fixed rate mortgage, years ago Congress passed something called PMI, private mortgage insurance. Anytime you borrow over 80% of the sales price or the appraised value.
If you do not put down 20%.
If you do not put down 20%, then it's mandated that you have private mortgage insurance on that loan. And basically, people get confused with homeowners insurance and what private mortgage insurance is and everything. Private mortgage insurance is a kind of a default insurance for the lender. It covers a small portion of that loan should that loan go into foreclosure or
Okay.
bankruptcy or whatever it might do. It has been tax deductible if you're able to take that deduction. It is added to your monthly payment, and it does come off your loan once you pay your loan organically down to 78.5%, I believe it is.
So
Now,
just over that 22% or
Do you
22.5%.
Do you have to check in, or does it automatically come off, or you have to call and make sure?
It will automatically come off if you pay it down.
Okay.
Now, you
okay.
can have your house reappraised and request that the private mortgage insurance company reduce or eliminate that monthly payment if you have enough equity in your house at that point. In other
Certainly
words,
have to pay for the appraisal, though.
you'd have to pay for the appraisal,
Right,
but
okay.
if your home value's gone up enough, significantly enough, to cover that 20%, then it's possible
That's
to
a
have
smart
those.
thing to do, yeah.
Okay.
Now, it's different on government loans, like an FHA loan, where they have mortgage insurance. It's not private mortgage insurance, it's government insurance. It stays on that loan for the life of the loan.
I did not know that.
It is-
I
it
did
is
not know
less.
that.
It
I
is-
just learned something too. I did not know it stayed on the
It
mortgage
does.
for the entire mortgage.
It's less.
Okay. Okay.
It's a lower amount than the private mortgage insurance, but it does stay on
It
there.
doesn't matter how much equity you have or anything.
It doesn't.
Stay.
Most people will start off with that loan, then at some point refinance their
Okay.
loan.
To a
That's
conventional
FHA?
after they, go ahead.
Yeah,
Go ahead.
that was FHA?
That's FHA.
And VA too? or-
And VA, they could. VA doesn't have mortgage insurance.
Okay.
So if you're lucky enough to have veterans benefits, which I
Yeah.
think is a wonderful loan, then you don't have mortgage insurance. You can borrow up to 100% of the appraised value and
Great.
don't have to have mortgage insurance at all. But keep this in mind too, that people that are buying houses right now are understanding that rates are where they are, which again aren't terrible. People are still buying and selling houses, but you're going to refinance in 18 months when rates come down,
Good
and
point,
we're
yes.
offering also that if you close a loan with us, that we will refinance your loan with no lender fees as well. So to kind of take the sting out of that when
That's
rates do come
great.
down.
Yeah.
That's super.
Well, I just realized what time it was. Dave, I could sit here and ask you more questions. I know we have to close this morning, though. I hope this was helpful. This was super helpful for me. Obviously, I just learned that PMI, or not PMI, but mortgage insurance, not private,
Right.
stays on a government-backed loan, and I did not
FHA.
realize that, FHA. Anyway, I appreciate you being here today,
Oh,
especially
absolutely.
last minute
Yes.
with our
Sure.
scheduling conflicts. So
Anytime.
thank you so much. Obviously, Dave Ashman's phone number is on here. Feel free to call Trevor and I if you need anything, and we'll look forward to seeing you in 2 weeks. Enjoy the spring.
Thanks.